The number one tax mistake that I see investors make routinely is not properly adjusting their state income tax return with respect to their investments. The mistake is this: investors receive a 1099 from their custodian, like Fidelity, Schwab, Vanguard, etc. And then they or their CPA simply take the ordinary dividends from their ETFs and mutual funds that probably contain US government securities interest and they don't know it. They take those ordinary dividends and put them on their state income tax return without making the necessary manual adjustment to those dividends. And the end result is that you end up paying more tax than you should. There is a necessary research step that needs to happen if you own ETFs or mutual funds that contain government securities. That necessary step is going to the provider of that mutual fund or ETF, researching what percentage of the fund's ordinary dividend comes from government securities, and then making the necessary adjustment on your state income tax return. If you don't conduct that step, you could pay thousands of extra taxes that you shouldn't be paying at the state level. Let me show you what I'm talking about and walk you through an example of how this mistake occurs. Let's say that you own the Fidelity Government Cash Reserves Fund, FDRXX, a money market mutual fund. Many people own it. In 2024, 57.19% of the fund's dividend came from US government securities. And what that means is that over half of your dividend should be state tax exempt, assuming you live in a state that has an income tax, which is most states. Here's where the mistake happens. When you get your 1099 from Fidelity, it's going to show the entire amount of the dividend that you received. In this example, we're making an illustration for a $75,000 dividend. If you do not conduct the necessary research on what percentage of the fund's dividend came from US government securities, and then make a manual adjustment to your state income tax return, you'll end up paying tax at the state level on the entire dividend. The 1099 isn't going to show you how much of the fund's income, or the dividend rather, came from US government securities. You need to go do that on your own, you or your CPA. And many people make a mistake here. They simply take the entire dividend and add it to their state income tax return, when instead they should be making an adjustment at the state level so that they receive the state tax exemption on the portion of the dividend that came from US government securities. For many of you, you're going to end up paying extra tax that you shouldn't be paying. And for some of you, this tax could be thousands of dollars if you make this mistake. In this example, for a person who earned $75,000 in dividends on FDRXX in 2024, they should only pay state income tax on $32,108. But many people will end up filing their state income tax incorrectly and paying tax on the entire $75,000 at the state level when they should not. If you have an asset allocation portfolio, it's just about a guarantee that some of your ETFs or mutual funds, whichever you use, are going to have US government securities interest in some of those investments. It's up to you or your CPA to conduct this research and determine what percentage of your dividends from your ETFs or mutual funds came from US government securities, to make sure that you don't overpay on taxes at the state level. Let me show you how to do this research. Let's say you have investments at Fidelity. You need to go to Fidelity's tax information page, scroll down, and click on the file that says percentage of income from US government securities. When you open the file, this is what you're going to see: a list of Fidelity funds, the symbol, and then the percentage of the dividend that came from US government securities. I've highlighted an example here, the Fidelity Balance Fund. In 2024, 24.06% of the fund's dividend came from US government securities. That means that 24% of the fund's dividend should be state tax exempt. For those of you who own Fidelity Freedom Funds, Notice that every single one of them has US government securities interest. If you have investments with iShares ETFs, you'll need to go to their US tax library, scroll down, and then click on the US government source income information file. When you open the file, you're going to see a list of ETFs and the corresponding percentage of the dividend that came from US government securities. I want to highlight the BlackRock International Dividend ETF. This is an all-stock ETF. But notice that 0.72% of the dividend came from US government securities, and that is because the fund has a small position in cash. So when you do your research on your investments, you want to be thorough, because it is likely that you will have funds where you might not expect that they would have US government securities interest, but in reality, they do. This tax issue that we just reviewed is far more common than most people realize. And it's not just individuals who miss it doing their taxes on their own. Many CPAs miss this as well. It requires a lot of research. If you have an asset allocation portfolio in an after-tax account with lots of investments, you have to do a lot of research. Many people miss this. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.